Hey guys, my name is Milano. For those who know me, you know me as a Forex trader, a very successful one. I've been getting a lot of people asking me to make a video on how Forex works, and I understand that if you try to search up Forex and how much you can actually earn, there's not an actual explanation quite specifically on how much you can make on Forex. So I decided to make this quick video to show you guys the amount of profits you can make, what's realistic, how it works, and generally how much you can profit per minute, per hour, and so on and so forth. So after this video, you should have like a general understanding of how trading works. So anyways, here we have the lot sizes chart. This table will show you how much each lot size is worth per pip value. Now, generally speaking, when you're trading Forex, the textbook term for each pip is on the fourth decimal point. So this is the textbook definition, and I'm going to show you why I don't follow the textbook definition. So 0.0001, they will calculate this point as one pip. However, I do not go by that. There's a very good reason why. Okay, I also own an educational service, so I do this so that it's more simplified for my students. Now, if you've been trading, or even if you haven't been trading and look at MetaTrader 4, like TradingView, or any of the pricing chart, you will notice that price does not move on the fourth decimal point. Believe it or not, it actually moves on the fifth decimal point. So this, I actually calculated with the fifth decimal point. That way we can calculate the lot sizes a lot easier when it comes to pip values. You can say 1 for 1, 10 cents is 10 cents, 0.01 is 1 cent. Now if you were to go by the fourth decimal point, you have to do the calculation of calculating one lot as $10 and 0.10 lot size as $1 and so on and so forth. This is a lot more easier to calculate. So for that reason, because the reason that pips move, the smallest price increment that moves in Forex is fifth decimal point, and it's not fourth decimal point. So for that reason, we teach our students to go by the fifth decimal point. Now, let's get into Forex. So I'm sure you guys have seen charts going like this before. Okay, so let's say, sorry, my drawing is like pretty terrible. So let's say this is the Forex chart. Now, how do we make profit on Forex? Basically, what you're doing is you're betting that the currency will either rise against the counter pair, or the primary currency will lower against the counter pair. And based on that, if the primary currency rises against the counter pair, the price will either go up in the graph or it will go down. Alright, so here you can see that it's going up. So this means that the primary currency is going up, and this means that the primary currency, counter currency is going up. So in this case, a primary currency is going down against a counter currency. So I'm gonna give you an example. So we're gonna put Euro, USD. So basically, it's gonna look like this. If Euro rises against US dollars, the chart will do this. Now, if the US dollar rises against Euro, Euro USD will start declining. And then if Euro starts to gain back power, that's when the price will resume its original trend. So this small movement is called the retracement, but we're not getting into that right now. We're just gonna cover the basics. Okay, so how do we profit off of this movement? So basically, we can do one or two things. I mean, there are other types of orders you can do, but right now we're just gonna stick to buy and sell. So what does it mean by buying Euro USD? So when you say buy, you're pretty much betting that the Euro will rise against US dollars, which means you're betting that the price will go upwards. So on an average, on a good moving market, you can look at anywhere between 50 to 300 pips in price fluctuation under a minute. Now I'm saying good moving market. There are times where it barely moves, so don't quote me on that. But let's say it's moving about, let's pick the middle, 250 pips, right? So let's say the price here is okay, so let's say the price is at 1.32600, okay? I'm just making up numbers here. So just to give you an idea. So let's say you bought at 1.32600. So right here is the entry point. Entry. Okay. So let's say about a minute has passed and price is now up here. So now it's gone up 250 pips. So here you're at 1.32850. So to calculate the position value, all you have to do is subtract the last couple of numbers that's been changed. So all you have to do is just, okay, so you can see that 850 is higher, so you would subtract 600 to 850, then you're going to be left with 250 pips, just like I said. Went up 250 pip in value, right? So how do we calculate the value now? So that's when the lot sizes comes into play. So let's say you purchased about one lot size, which is very standard. Based on 1 to 200 leverage, you can trade up to one lot size with $500 capital. So let's say you had 1 to 200 leverage, and you had $500 capital, and you decided to invest one lot. Okay, so you did one lot buy. Okay, so you bought one lot. Again, like, sorry about my writing, it's kind of horrendous. Anyway, so you bought one lot and it's gone up 250 pips. So this is in profits, right? So we know this is in profits. So this is how you're gonna do it. You're gonna multiply 250 by the lot size, which is 1 at this point, and that's exactly as it is. 250 times 1, you just made $250 US, and under a minute, because right here to right here was one period. Now let's switch it up a bit. Let's ramp up the number. Let's say you had a larger capital. Okay, so let's say you had $3,000 and you decided to buy 6 lots, which is the maximum amount of lot size you can buy. Okay, so you invested $3,000 into Forex, and you decided to purchase 6 lots based on 1 to 200 leverage. Okay, so you bought 6 lots, and it went up 250 pips. So you're gonna multiply 250 times 6. Okay. Profit. So this now becomes $1,500. There's a lot of factors that comes into play, which we teach you in our educational service. But this is just for you guys to get a general understanding of how you can make profit on Forex. So there you go, guys. Based on $3,000 capital, you invested 6 lot size, which came into a play. And you ended up profiting $1,500 US, which is approximately about $1,900 Canadian. CAD. And some of you guys might be asking, okay, so if I invest $3,000, is it possible for me to lose everything? And the correct answer is yes, you can lose everything. However, it's very unlikely for you to lose your entire capital all at the same time, unless you got a margin call. So margin call is when you exceed your minimal amount of margin that you need to maintain to keep a position open. So the way Forex works is like this. It's all about fluctuation, right? So when you open a position, even if it's down by like 1,000, you don't actually lose that amount so long as it goes back into profits and you have enough capital and your equity to maintain the fluctuation. Now, if you had only 1,000 and you've gone into negative 1,000, then for sure you would have got a margin call. Another thing that you can do is this thing called a stop loss. So stop loss will actually stop your loss after a certain amount. You can put in an X amount of pips to eliminate the chance of you getting a margin call. So there's a lot of various like different factors and risk management tactics to apply so that you don't really lose your entire capital. So there you go, guys. This is how much you can make off of Forex trading. I hope this video was educational. If anyone have any further questions, please reach out to me.